Well, good morning. Welcome. I'm University of Illinois Extension's Todd Gleason, farm broadcaster here on the Urbana-Champaign campus of the U of I. This is a FarmDoc daily webinar, Carbon Markets 101, what questions farmers should ask. Krista Swanson is with us, Sarah Sellers, along with Gary Schnitke. We appreciate having them on board. So we'll go through a few things today. First, how are we sharing carbon market information? You can find that on the FarmDoc Daily website. Just go to farmdocdaily.illinois.edu. You can search it out. Or if you check out our YouTube playlist, which is pretty simple to get to, youtube.com/farmdocvideo. That's that website address right there on the page, youtube.com/farmdocvideo, and you'll find the Carbon Markets Video 101 there as well in our playlist. So what are the topics for the day? Well, we'll start out with a little background about the carbon markets, and we'll use some examples for the carbon market contracts that we know about. We'll have some questions that you need to ask as it's related to carbon markets, and of course, we'll check out what the policy environment is as well. And learn a little bit about something called climate smart agriculture and forestry. Let's take a quick poll on a few things that are happening for the day. How many acres will Illinois have in carbon markets in 5 years? So we're going to ask this question of you. Just go ahead and fill out the poll. How many acres do you think Illinois will have in carbon markets in 5 years? Less than 5%? 5 to 25%, 25 to 50%, or over 50%. How many acres in the state of Illinois will be enrolled in this market? Once we get 5 years out, we've got about 60% of you that have answered that question so far. We'll give you an update here momentarily. We'll get to about 70, 75% normally, and we try to put the answer to that question out. So we'll look forward to having that. Almost there. 70% of you have voted at this point, and there you go. Carbon markets, 57% of you say that it'll be 5 to 25%. That's the biggest gap, or the biggest part of what you all are thinking. And just 3% of you think there'll be more than half of the acreage that will be in place. Let's get started with the specialist of the day. Again, I'm Todd Gleason, your host, farm broadcaster. Krista Swanson is here, and she's going to take you through the beginning of this carbon markets webinar. Good morning to you, Krista. Thanks for being with us today.
Good morning, Todd, and thanks to all the listeners for joining us this morning. We are going to be digging into this topic of carbon markets that some are referring to as the Wild West. So when I hear that, I think that that term is representative of us navigating into this new territory, but also looking at it as a frontier of opportunity for agriculture. So if we want to jump ahead to the next slide, first I wanted to give a little bit of a background on what makes carbon markets such a hot topic right now. The results of the 2020 election have a great deal to do with the current emphasis on climate change and carbon markets. Certainly addressing climate change is a known priority of the Biden administration and the Democratic Party in control of Congress, but also really the election probably just brought about or sped up the pace of addressing the inevitable. And so with that, we anticipate that any future changes in Congress or the administration could alter the speed at which we address climate change or the approaches taken to address climate change, but probably would not alter the overall trajectory that we're on now. And another reason for carbon markets emerging is this policy goal, and we'll talk more about that later, but the policy goal of carbon neutrality in man-made activities. And so what this means is we want to achieve this balancing of emissions of carbon with removal of carbon. And so this is where opportunity for agriculture comes in. Looking ahead at the next slide, the graph here shows emissions by economic sector in carbon dioxide equivalents. And one thing that jumps out first to me is transportation, electricity generation, and industry account for about 3/4 of US carbon dioxide emission equivalents. And agriculture accounted for 10.2%. And this data is taken from the United States EPA, and it's for the 2019 year. But that amount for agriculture coming in around 1/10, as kind of stayed about at that level. And so even though the agriculture sector is responsible for about 1/10 of US carbon emissions, agricultural activities are actually looked at as a sink for carbon, because a carbon sink is anything that absorbs more carbon from the atmosphere than it releases. So we are an emitting industry, but at the same time, we're also have the ability to absorb and capture, sequester carbon. And that means that we have this opportunity to have a role in sequestering carbon to help offset emissions from some of these other sectors who don't have that ability. And there's a real emphasis on sequestering carbon in our soils. And so why now? And this is a bit of a repeat from 2 slides ago, but just to reinforce the influence of the current political leaders on the speed at which we're tackling climate change. Early in his presidency, Biden issued an executive order back in January that really brought American farmers into combating climate change. And a lot of the actions we have seen this year, which I'm going to go over in more detail later, are a direct result of this executive order on tackling the climate crisis at home and abroad. So we kind of have 2 efforts happening simultaneously. We have this government policy tier, which includes actions coming from Congress and other administrative activities. And these things are kind of tied to that executive order I just mentioned. And then separately, we have this emergence of private carbon markets. And before we talk more about policy later in this webinar, we're going to go through some of the ins and outs of the private carbon markets. And so I'm going to turn over to Sarah now to begin that part of the webinar.
Thank you, Krista. So we're going to go ahead and start with talking a little bit about agriculture's sequestration potential. So the U.S. has pledged to reach net zero emissions no later than 2050. And we're also seeing a lot of companies announcing goals to also reach net zero emissions. It's estimated that U.S. agriculture and forestry could provide 10 to 20% of the sequestration and emissions reductions needed. Currently, it's estimated on U.S. cropland, there's about 8.4 million metric tons of carbon dioxide equivalent per year being sequestered. And the annual potential is estimated to be 100 million metric tons of carbon dioxide equivalent per year. So we can see there's a lot of potential here with agriculture. And the point I want to make here is that the U.S. and many large companies have made promises to reach these targets, but they need to have a way to reach them. And I included this emissions graph again because I want to take a look at the largest polluting industries. If we look at transportation, if we look at electricity generation, and if we look at industry, these are where most of the emissions are coming from. And the point I want to make here is that making reductions in these areas sometimes requires more long-term investments and time. And if we think about agriculture as a solution, the agriculture, we can make some of these changes fairly quickly. So for example, changing the U.S. transportation sector is a huge undertaking. Of course, there's small changes and efficiencies we can make, but a lot of the focus has been on electric cars, electric vehicles, and this requires a large infrastructure change to support charging station and to support the switching to electric vehicles. And this takes time and infrastructure changes. And that's the same with electricity generation. Of course, there's processes we can make, ways that we can make these processes more efficient. But if we're thinking large long-term infrastructure change, there's been a lot of focus on solar energy and wind energy. And these also both require infrastructure changes and time. It takes time to build and adopt these things. But if we look at agriculture, we can have some of these changes fairly quickly. Within a growing season, we can see some fields switching to no-till, switching to cover crops, and reducing nitrogen fairly quickly and begin sequestering that carbon over a period of a few years. So the main point here is that many people have made promises, companies and government, to reach these reduction targets, but we need a way to reach these reduction targets. And one of the ways we can get started on this, we can see some quick results without getting into some of these significant infrastructure changes, is through agriculture. And agriculture can be a large contributor to carbon sequestration. So we've seen the word climate smart a lot, so I kind of wanted to go over a definition of climate smart and talk about what exactly are climate smart practices. So the definition here I'm using is from the USDA's Climate Smart Agriculture and Forestry Strategy 90-day progress report that was released in May. And they define climate smart as activities that store carbon and improve resilience in soil health. And some examples they give in that report are reduced till and no-till, cover crops, prescribed grazing, reduce greenhouse gas emissions. We see the main gases emitted in agriculture are nitrous oxide and methane. Ruminant feed management, manure management, fertilizer management, improved on-farm energy efficiency, and improved forest management. So we see that these are some examples of activities, but these are not all the activities we see being part of the carbon market and being paid for as of right now. Not all of them, some of them. So we'll talk a little bit about private carbon markets. So we have the farmers who are selling their carbon credits, generating these carbon offsets, and then the integrators who are buying these credits from farmers. And the integrators can either use these credits within their own processes to reach their own net emissions goals, or they can sell those to private companies. So, and then these private companies, they purchase these carbon credits to lower their carbon emissions and hopefully reach their emissions targets. So as long as these entities cannot meet their goals themselves by making their production practices more efficient, then they're going to need to look to another source for a solution, and that source can be carbon credits. If the price of carbon credits becomes too high, then maybe they will look to another source. But right now, it appears there is significant demand for carbon credits and an expectation from a lot of companies that the price of carbon will increase. And carbon credits, another thing to keep in mind is that carbon credits have to be new. This is to satisfy this idea of additionality and to be able to quantify that a real change is happening, to be able to measure and sell that. So this is the reason why farmers typically can't get paid for some of the practices they've adopted in the past. So one question we've been getting a lot is, how do you measure this? So there are different things you can use for measurement. You can use remote sensing, which is using satellites to look at things like cover crops and tillage. Some pros of this are it's very scalable, it's relatively inexpensive. You have soil sampling, which may be more expensive, and it's not as easy to scale, but it could be more accurate than some of these other options. And also we have indicators, which are things like the amount of fertilizer added to a field. And this can indicate the level of greenhouse gases being emitted to that field. And then we can also use computer models to tie all of these things together. So when we're thinking about cost, when we're thinking about accuracy, and when we're thinking about scale, modeling is the most feasible way to measure these changes. And another point I wanted to make here is that we spoke with a company in Alberta, and they have been doing agricultural carbon credits there for a while. They have a government system in place for doing this, a regulated system. And the person we spoke with mentioned that when the carbon market first started in Alberta, there were 10 companies that were serving as integrators for these agricultural carbon credits. But after a few years, only 3 remained. And the reason they mentioned for this change is because the other companies, some of them didn't have the modeling capabilities. So one thing we can kind of learn from this is that modeling is probably going to be a big factor here in the market. Another thing we see in the market is a need for agronomic support as well. So what we're seeing in the market is a need for agronomic and sales support for the farmers adopting these new practices. Then there's a need for the modeling technology for the measurement and verification. And then there's a need for demand either within the company or the company having connections with demand to sell the carbon credits to. So that's why we've seen some companies partnering up, software companies and agronomic companies, so they can kind of meet these three areas and be able to offer the whole package to farmers to help them through this carbon markets. So some of the benefits for carbon markets as interest grows in no-till, in nitrogen reduction practices, cover crops, we know there are costs to adopting many of these practices, and carbon credits could present some financial incentives for farmers to adopt new practices that they may not otherwise receive. With many companies, you can stack carbon credits with other programs, such as EQIP, and this would allow farmers to reach approximately $40 to $70 per acre of payment, and this could help to cover some of those costs of adoption. And another thing to keep in mind is that there are co-benefits to many of these practices, such as benefits for the air, biodiversity, soil, and water. So these are not always being valued in the price, but there are other benefits to these practices that are being adopted. So one thing farmers should think about when they're considering entering the carbon market, when they're considering adopting a new practice, is the break-even price. So how much, if I switch to this new practice, how much would I need to receive to break even? And the break-even price represents the carbon incentive level where adopting a carbon sequestration practice becomes economically viable for the farmer. So this is the point where the net present value of the benefit is equal to the net present value of the cost. For example, the price of carbon would need to be $32 per carbon credit for the farmer to break even from switching from conventional tillage to no tillage on soybeans. So if we look on our chart, the break-even price is $32 per carbon credit, and the estimated emissions reduction potential is around 0.13 metric tons of carbon dioxide equivalent per acre. So one thing to keep in mind is the break-even prices in Table 1. They serve as a general estimate, and the break-even prices will vary from farm to farm, depending on costs, soil types, and other factors. Another thing to keep in mind is that break-even prices are from a report prepared by IFC International for the USDA in 2013. So it's likely that prices and costs have changed since the publication of this article. This article can serve to give us an idea, to give us some background about some of these break-even prices and emissions reduction potentials. And here we just go through an example looking at, okay, let's say we receive $20 per carbon credit for our carbon credits, and we just want to put that in per acre terms. So if we look at switching from reduced till to no-till on corn, the estimated emissions reduction potential is 0.42 metric tons of carbon dioxide per acre, and we receive $20 for our carbon credit, which represents 1 metric ton of carbon dioxide equivalent. If we multiply those, we get $8.40 per acre. And we can also look at the same for soybeans, put that in perspective, and put that in a per acre basis. We can also look at the break-even prices for some fertilizer practices. Here, the VRT assumes a 1,000 acre farm and the adoption of green seeker technology. And here they estimate two different scenarios: a low nitrous oxide emissions reduction scenario and a high nitrous oxide emissions reduction scenario. And we can see some of these estimates, emissions are pretty small. But for example, if we reduce our nitrogen fertilizer application rate by 10% and we assume a high nitrous oxide emissions reduction potential of 0.16 metric tons per acre of carbon, then we would need a carbon credit price of $32 per acre to break even. When we talk about cover crops, so the previous study did not do a quantitative analysis of cover crops. So here we've collected a couple of studies about cover crops and carbon sequestration. Cover crops could play a large role here in carbon sequestration. The average sequestration is estimated to be around 0.5 metric ton of carbon dioxide equivalent per year, but this really depends on the cover crop planted. And one study suggests a carbon credit price of $10 could meet a large percent of the mitigation potential of cover crops. So here we go through an example of per acre payments for cover crops. If we assume a $20 per carbon credit price, We look at the average sequestration of 0.5 metric ton of carbon dioxide. We multiply that by our $20 for our carbon credit, and that comes out to around $10 per acre. Another question to think about is, what should the price of carbon be? So when we initially started working on this carbon markets project back in March, we saw many companies mentioning prices of $10 to $20 per carbon credit. We have seen that change a little bit with some companies starting to offer some sign-on bonuses. But we expect to see more changes in the future based on how much the carbon credit market has changed since we began working on this in March. And there's one study that estimates that the price of carbon may need to be somewhere between $50 to $100 per credit to kind of meet the target mentioned in the Paris Agreement.
So that so we have another poll for you, and we're now moving on into what contracts are out there. We do have a number of, if you wouldn't mind answer this poll, we do have a number of questions. One of those is, what is the source of the estimate of annual potential of 100 million metric tons of CO2 per year? And largely that would be from a number of sources, but if you think about it from a cropping standpoint, it would be for anything that causes CO2, more CO2 that's taken up by the plant to remain in the soil. So that would be reducing tillage. We generally see increases in tillage results in more CO2 emissions, and a cover crop, because it's a growing crop, would take up CO2. We have a question: what is the name of the IFC International article done for USDA in 2013? I'm not sure we have the answer to that right now, but we'll figure it out and we'll put it out in our notes. So 57% of you have voted. Let's see. And right now we have over 200 people on here, so that'll give you a feel for what you're thinking. And here's our results. Have you or someone you know entered a contract? Yes is 6%, no, but in the process of signing a contract, 1%. 39% say you're interested. No, 54% of you say we will take a wait and see attitude. So that's where we're at. There are a number of contracts currently being offered to farmers. And it's important to remember that these are new contracts and that we will see changes as we move through time. A good source for the contracts being offered to farmers currently is Scott Gerlt from American Soybean Association. You'll see a link there. We will also link this to our YouTube video description when that is posted, so you don't have to copy that down. But Scott's going to keep that website up, and this was updated as of August or last month. On that website, Scott has a number of contracts that are contracts listed from Bayer, Corteva, Gradable, Economic Ecosystem Service, Indigo, Nori, and Soil and Water Outcomes Fund. So you can go to that website and see what the basic terms of those contracts are. And if you look at the bottom of that website as well, you will see a link to the website that will provide you more information on those contracts. If you go to that website again, what you will see there are a number of categories: payment amount and basis, when the payment is being made, and going down the list as you go down that list of the items that are summarized for each one of those contracts. If we're looking at those contracts, remember again, Bayer, Corteva, etc., could be using those carbon credits to offset what they themselves are doing, but are more likely selling them to other companies who want to offset carbon credits that their particular firm is emitted. We have a question. Most of Illinois farmland is rented. Actually, it's 50%. So yeah, you're right. Most 50-50. And as we go to larger farms, our commercial grain farms typically own 10 to 20%, which means that they will be renting over 80% of the land. What incentives are landlords going to receive? Where's the money? In some of these cases, and you'll see here, must the land be owned is one of the questions that comes up in each one of those contracts. So that will vary by contract. We're just going to give you a feel for some of this slide summarizes the payment amount and basis that is used on a number of these contracts. And we have differences. Practices per acre, one contract, Bear offers payments based on practices per acre. So the Bear would pay $3 per acre for reduced tillage or moving from conventional tillage and to reduced tillage, and $6 per acre for a cover crop. That would be their contract. And again, there would be specific items that need to be covered for each one of those. A number of them offer a payment based on per ton of carbon credit. We can see there that those range from $10 per ton to $15 per ton. I would also note that if you sign one of those contracts or go with one of those companies, the carbon credit may not be the same across the companies. So making a strict comparison based on just carbon credit, again, these are models, and models will vary across for what carbon credits are. A number of these contracts also include some ground truthing in them. Currently, the carbon price range appears to be $10 to $20 per ton. And if you look at what Sarah was showing earlier as the carbon reduction potential, you're looking probably at some sort of payments of between $5 and $15 per acre for the potential for carbon credits at this point in time. And again, those could change and likely will change as we move forward into time. Almost all of these require some data to be provided. Almost all, most. I'm taught never to use all or that all, but almost all requires some entry of information. A number of those have specified those in Climate View for Bear, Granular Insights for Cordiva, and Gradable for Farm Business Network. The linkages there do make sense. Many of them require 3 years of previous information. So what they're doing there is calibrating a model and then saying, here's what it has been, here is what it will be. And there may be, again, some ground truthing done. There may be some spot checks done to see that those models are working in a appropriate manner, and you will likely be required, and I would almost put almost always likely to require boundaries and practices for the coming year, so that that you can look at those. Another question. So can early adopters participate? So a number of these require a practice change. So for example, if you're doing full tillage now, will I qualify later is one of our questions. And if you're looking at the contracts that exist today, if you're doing full tillage now, you would qualify later. Again, that's assuming that those contracts stay in place, but most of these require a change in practices. For example, they would require changes in tillage practices, usually going to a reduced or minimum or no-till practice, and require cover crops. And most of those require those to be adopted relatively recently, and they do vary. And just to give you a feel for the variability, Bear would require a practice have to be adopted since 2011. They say that if you look at their contract, it says 2012 and before contracts or practices won't be compensated and gradable, then has practices must be adopted in the last 2 years. Again, just to give you a feel for the variability that exists across these contracts. There are, as you can see here, quite a bit of variability across the contracts that currently exist. And and Sarah has put together actually a FarmDoc Daily article several months ago, and again, we will link to that. But if you're looking at at those contracts, there's a generic list of questions that you should ask about those, and so Sarah's going to cover those.
So overall, we've seen a lot of general concerns from farmers who are interested in selling carbon credits. So we're going to go over a few of those questions that farmers should ask. So the first question is, how do I enter the carbon market? So there are typically two approaches a farmer can use for entering the carbon market, an aggregator or data manager. So with an aggregator, the farmer sells the entire project, control, and credits to the aggregator in terms and conditions set up in a contract. And then the aggregator then has complete control over the carbon credits, when to sell, the price, and the data shared. With a data manager, the farmer pays the data manager to help them enter the marketplace for a fee or revenue percentage, and the farmer has not sold real interest in the project or carbon credits. One big question farmers should ask is, how much will I actually be paid? Chris is going to get more into the policy side of things later, but I'll just briefly mention that there is a new section of the Growing Climate Solutions Act. It's titled Fair Treatment of Farmers, and it would require the USDA to ensure technical assistance providers help farmers, ranchers, and foresters to receive fair distribution of the revenue derived from the sale of carbon credits. So this is something to keep in mind, that policy could be a factor here if this act passes, and things could change. Another question to think about is about the ownership of data. So who owns my data? What can be done with my data? How can my data be used or shared? And another question to think about is, what currency is my payment in? The payment is typically in cash, but some programs may also offer a cryptocurrency as well. So it's important to get a clear answer on this. A big question to ask is, how long will it take to get the money? A portion of the money may be paid up front or issued at a future date. There may be a payment program to give the farmer a certain percentage of credits or payment gradually over a specified period. Another question to ask is, can carbon credits be stored? So from talking with companies, we've heard from a couple companies that they are expecting some upside potential in the market. So if a farmer does not get to keep or store these carbon credits, then they could miss out on some of this upside potential. How much will it cost? The farmer may have to pay for soil testing, or a lot of times now we are seeing the company cover the cost of this soil testing. There could be other fees the farmer is responsible for, or the company may keep a percentage of the credit or withhold part of the credit to cover fees or the natural loss of carbon. A big question for a lot of farmers is, can I be paid for the practices I'm already doing? And Dr. Schnitke kind of covered this earlier, but many farmers feel they should be eligible because they have been doing these practices for many years on their farm. And again, we saw quite a bit of variability in those contracts. Most companies say you had to have adopted the practice at most between 2 to 5 years ago. However, there are some companies who will allow you to go back even further, maybe up to 12 years. Another question to think about is, how many years am I locked in a contract for? So typically what we're seeing is contracts between 10 to 20 years, but we all know many things can change within that time period. So it's important to clearly understand any penalties for violating the contract and any liabilities the farmer has if the land changes hands. Another big question to consider is, what happens if the land changes hands? So if this is rented land and the land changes hands, is the farmer responsible? So companies are typically building in what they call buffer pools by purchasing more carbon credits than they are selling as a way to manage the risk, with the expectation that some farmers may drop out of the program. So some companies state that they will deal with these situations of land changing hands on a case-by-case basis. So the outcome for the farmer depends on the company and what's in the contract. Another question to think about is, who needs to be involved in the decision to sell carbon credits? So some companies require an attestation of right to sell carbon, and others have a box that says, check here if you've received your landlord's permission. So we're seeing quite a bit of variation in the contracts. Another question is, what practices are companies typically paying for? So typically right now we see payments for reducing tillage, changing nitrogen rate or practices, planting cover crops, and changing crop rotation for crop farmers. There also could be opportunities in the future for livestock producers and forestry management, so we'll have to see what happens. Another thing to consider is if there is a per acre limit of carbon credits. So maybe the company limits you to 2 carbon credits per acre. So it's important to keep this in mind. Another thing to think about is how often will someone need to verify my information? Someone may need to visit the farm to collect soil samples or verify information. So it's important to get a clear answer on how often this will occur. Another question to think about are what penalties are there if I do not follow the contract? So some companies are dealing with this potential of farmers dropping out, as I mentioned earlier, by setting up a buffer pool of credits. So the company contracts for more credits than they are selling, with the expectation that some of these farmers will discontinue their projects. So the companies are bearing the brunt of this risk. Other companies, they may have a penalty or settling up if the farmer decides to withdraw. And finally, is there a limit to the total number of acres I can enroll? Is another question to consider. And I want to mention this document as another resource. We've been sharing this document with farmers. It's an extension publication from Iowa State University. It's called How to Grow and Sell Carbon Credits in U.S. Agriculture. We'll link this document in the caption of the video. So we put together the FarmDoc Daily article called What Questions Should Farmers Ask About Selling Carbon Credits? And this document here goes through some of those questions and tries to answer them for 11 different companies. So this is another tool for your toolkit when you're trying to make a decision and thinking through whether you want to enter the carbon market.
So now we have another question for you as we do this poll, and carbon credits are now in the $10 to $20 per ton range. So put your forecasting hat on, just like you do for corn and soybean prices. What will the value of this be in 5 years? We have had a number of comments, and one of those is that the CMT has been offering a carbon credit, and those are selling for now $10 per ton, according to our comments. And so we're seeing some of those contracts move on. As we're getting closer to the end of the poll, 54% of you have voted. So you're giving us a feel for what you think these carbon markets will be worth. And here is the answer to the poll. 4% of you think that there's going to be zero. So no carbon markets for ag. Most of you don't believe that, which will be interesting. Up to $10 per ton, 9%, 27% of you think between $10 and $20 per ton, 48% $20 and $50 per ton, and Jim suggested we put over $50 per ton. Our great Jim Baltz, who manages our videos, I said no one would believe that, but 12% of you do believe that. So now we're going to go and talk about some of the policy background associated with these carbon markets, and Krista's going to, or carbon markets, and more generally the carbon climate change efforts. And so Krista's going to take that away from you, for you.
Yeah. Hi. And before I get started on policy, I just have a comment on that poll. I noticed, so Gary says, he didn't know that anyone would believe that being over $50 a ton. And I guess just to elaborate on that a bit, the reason that he makes that comment is because, and we've gotten this question as Gary and Sarah and I have talked to various other farmer groups, where is the equilibrium point for the carbon market? And that's an unknown because it's still in the early stages. And I guess it hasn't reached a market equilibrium point, but I guess one would suspect that as I guess I'll back up. Another thing, that feedback we've gotten from farmers is that the current price isn't really covering the costs for farmers to adopt the practices needed to generate those credits or to continue doing them at a larger scale. And so from the farm level, you would expect that price to need to be higher. But at some point, you reach a point where that gets so high that the end users or the companies interested in buying these credits no longer want to spend that much, and they might in turn make an investment to make some of those more costly changes that Sarah talked about earlier, to be able to reduce their emissions level. So anyway, I just wanted to explain that a little more for someone that may have marked that over $50 per ton. So moving into the policy background, I wanted to talk through some of Congress's climate milestones over the decades, a little bit about the Paris Agreement, some more about what's happened in 2021 in terms of ag climate policy, digging into the Growing Climate Solutions Act just a bit, and then what to watch for going forward. So on this slide, in the interest of time, I'm not going to go through each little box here, but what I kind of wanted to show with this is that we tend to think of climate, or at least I personally tend to think of climate change as being a big and relatively new topic right now. And so some people may not realize that US Congress has been debating climate change for nearly 30 years. And in that time, there has been laws and congressionally approved funding that has led to new programs to reduce emissions and speed development of clean energy. So for an example, there was the renewable energy legislation from 1992 that created a renewable energy tax credit. And this is what's been kind of critical in this rapid expansion of the wind energy industry that we have seen over the past 2 decades. Another interesting thing I wanted to point out is that the idea of a global agreement to tackle climate change dates all the way back to 1992, when there was initially a United Nations agreement on climate change. And I'll talk more about the current international agreement on climate change and just a climate change in just a moment. But a few other highlights from this. From 2003 to 2007, there was actually pretty significant bipartisan efforts to reduce US greenhouse gas emissions, but nothing was ever passed. And then in the President Obama era, of course, climate was one of his top legislative priorities. And again, there was a lot of climate-related bills introduced from both sides of the aisle, but nothing ever achieving enough all-around support to become law. And then, of course, since 2019, we've seen this renewed interest in climate change, and then particularly over the last year, since Democrats regained control of the House, Senate, presidency, we've seen this really speed up, and this is kind of circling back to what I said at the very beginning. And so now to dig a little bit into the Paris Climate Agreement. So this is a legally binding international treaty on climate change. It's called the Paris Agreement because it was adopted in Paris, and it was adopted in 2015. And this deal actually united nearly every nation in the world in a single agreement. And so that's a significant factor about this agreement. And what it did was establish a framework for addressing global climate change through mitigation goals and national adaptation plans, plus it included reporting requirements and some financial flow components. And really what the key effort is of this is to limit the increase in global temperature. So this is linked to a temperature benchmark set at the beginning of the Industrial Revolution. And then there's a goal to keep, we know that global temperature is rising, but the goal of this is to keep it from increasing more than 1.5 degrees above that pre-industrial level, and do so through the control of greenhouse gas emissions. And a key part of this is climate neutrality. And so I talked about that a little bit at the beginning as well, where basically, in short, it means that we need to have a balance between emissions from sources and removals or offsets by sinks. And the goal is to be climate neutral by the middle of this century. One interesting thing about this agreement is its bottom-up approach. And what that means is that each country, you don't have this high-level goal that everyone has to meet. Instead, it starts at the bottom. Each country sets its own reduction targets and then plans for how to meet its targets. And so that brings transparency and accountability and establishes a cycle of continuous action. Because each country is setting its own targets, there are times where nations may want to collaborate. And so in Article 6 of the Paris Agreement, this idea of voluntary cooperation and working towards climate goals is presented. And one of these approaches would create a new international carbon market. And so the reason I wanted to highlight this in today's webinar is because Article 6 is the only part of the Paris Agreement that is still under debate. And there's a United Nations Climate Change Conference coming up in November, and it's suspected that this could be debated and potentially resolved or settled in that time. And so depending on what happens or doesn't happen in terms of an international carbon market development could influence how the independent marketplace we've seen emerge in the United States, how it operates or continues, or if it does. And there's just a lot of unknowns in that. Actually, one of our 5-minute farmdoc videos in that webinar, or video series on YouTube is on the Paris Agreement, if you want to learn more. And so now I kind of want to talk about, we mentioned earlier this executive order that President Biden signed at the very beginning of the year. And really that was kind of the starting point that set off a series of policy actions over the course of 2021. And so in that executive order in January, the report mentioned multiple requirements requiring this another report following up in 90 days, which did happen. And it also mentioned this goal of conserving at least 30% of our land and water by 2030, which is commonly referred to as the 30 by 30 plan. And then, so jumping ahead to April, the USDA announced that it would open CRP enrollment with higher payment rates, new incentives, and more focus on climate change mitigation. And that program was open for enrollment for several months. And so that was another step we saw. Then on May 6th, there was a report released called Conserving and Restoring America the Beautiful. And it outlined the conservation goal that had been mentioned in that January executive order to conserve 30% of U.S. lands and waters. And so the report told us that 12% of U.S. land is permanently protected for conservation currently, which is very short of the 30% goal. And so there had been some concerns about where that 30% would be coming from and how we're going to move from 12% to 30%. Agricultural land could certainly be a part of that. USDA leaders have communicated that the intent is that this would be achieved through voluntary incentive-based programs through the USDA. And so that's, we don't have a whole lot of details on that at this point, but I guess that was another action as we continue to get more information. Later in May, the USDA published a 90-day progress report on climate smart agriculture and forestry, which really gave us more insight into what it is calling climate smart agriculture. Sarah talked a little bit about that. This report also gave us a lot of broad ideas, but did not mention specific goals. One important thing is that this report does not mention plans for a carbon bank, but it does note voluntary markets. And then in June, we saw the Senate pass the Growing Climate Solutions Act. And I'll quickly go through what that is. It's a piece of legislation that passed the Senate with very strong bipartisan support. And if you would have asked me at that time if this was going to move quickly and through the House and become law, I would have said yes. But the companion legislation is still pending in the U.S. House of Representatives, and we haven't seen that pass through near as quickly as I would have expected. The reason I would have expected this to move quickly is because, as Gary and Sarah have already covered, these carbon markets that are being organized are an excellent opportunity for farmers, but there's so much variation among programs and payment rates and how payments are based. And there's kind of a lack of regulation and consistency. And the real purpose of this Growing Climate Solutions Act is to address the constraints of the carbon marketplace and provide protections and assistance for farmers interested in participating in voluntary carbon markets. It would also set a baseline, identify practices, and create a third-party verification process for measuring carbon sequestration. And it would also establish an advisory council to work with USDA, including farmers, to make sure that the markets are adding value at the farm level. So really, it's an all-around positive thing from the farmer perspective, and hopefully we'll see some action that would kind of help us gain some clarity in the carbon marketplace. And then topics to watch as we wrap up today. USDA Carbon Bank with a question mark here. And like I mentioned, the information that's came out from USDA so far does not mention a carbon bank. Robert Bonney, who's the USDA climate advisor, has been a strong supporter for this idea of a USDA carbon bank, but we haven't seen anything official on that. And it's seeming that what we're seeing is that the federal government is indicating support through other actions for this private marketplace. So that's seeming less likely, although I don't know that the idea is completely gone away. Again, Paris Agreement Article 6, seeing what happens with that. The next two on the list here relate to the complexities with measuring carbon markets that haven't really been defined. Additionality, meaning are these carbon offsets something new? And then carbon leakage, meaning that maybe you have a farmer who's changing their practices in one area and then that maybe reduces their production, and then someone in another part of the world picks up that production and does so in not as sustainable of a way. And these are kind of undefined or maybe they're defined terms, but they're undefined how they would be handled. And then finally, what happens with climate-related legislation? In addition to the Growing Climate Solutions Act, climate policy tends to be tacked into a lot of different bills that are being proposed. And so there's a whole lot that could influence things in that realm. So with that, we will wrap up our presentation and open the floor for some questions.
We will indeed open the floor for some questions. Thank you, Krista Swanson and Sarah Sellers. Gary Schnitke have been presenting our carbon markets webinar for the day. I'm, of course, your MC for the day, Todd Gleason. We would like to thank the three of them, along with Jim Bolts, who's behind the scenes, and we'll make sure that this all gets up on our website. We'll tell you more about that in just a bit. Along with our FarmDoc sponsors, they include the TIA Center for Farmland Research. That's here on campus at the U of I. You can find it at farmland.illinois.edu. Compeer Financial, Corteva AgriSciences, and Farm Credit Illinois have also provided funding, along with the Illinois Corn Growers GrowMark, the Gardner Ag Policy Program on campus, the Illinois Soybean Association, and of course, the Department of Agricultural and Consumer Economics in the College of ACES here on the Urbana-Champaign campus. A couple of items that are coming up in our webinar series. The Grain Outlook is next week. That's at 11 o'clock on Thursday. And then the following Thursday, Gary Schnitke will be back along with Joanna Calusi. They'll be talking about Brazil, the United States, soybeans, and how farmers in both of those nations try to adopt new digital technologies. I'll bet they'll ask a few other questions as well. And we'll take some questions, speaking of that, from you right now. Gary, what have you got online for us today?
Yeah, so we have a number of questions that we probably can't answer, but one of the first ones was, does high productivity farmland in central Illinois sequester carbon? And the answer to that is yes, it does, according to the models. So if you're looking at model results and they're following best management yield practices, will they sequester carbon? And the answer to that is yes. We had a number of questions about rental arrangements and who gets paid. Is it the landowner or the farmer? And anyone of us can chip in. I would note that none of us are lawyers, that's a law question, but I have stayed a Holiday Inn a while ago, before COVID probably. But honestly, those answers would probably be handled, one, by looking at what those those carbon credits require, and some of those do require a combination of landowner and farmer signing if it's not owned by the other. And if there's nothing in the leases, then it's probably up to the split between the farmer and landowner. I would note that if you're signing a 10 to 20 year agreement, your lease agreement is likely only a 1-year agreement, so then you're going to have some issues there. Is soil carbon sequestration permanent, and can farmers just dig up captured carbon later?
So it's not necessarily permanent. So there will be some natural losses of carbon, and also that can be reversed. So if you adopt no-till and then you decide to till everything up later, then you can lose that carbon you stored. So that's why we typically see the contracts as 10 to 20 years to kind of guarantee that carbon storage for a period of years. But I don't have exact numbers about the magnitude of storage and the magnitude of losses of carbon.
So does the USDA currently regulate carbon market contracts in any way? And I don't know if the any way, I doubt that I doubt there's much activity at USDA, and that would be one of the things that Growing Climate Solutions Act would cover, is providing some transparency and some regulation of the market. But if you're looking for something like the CFTC for futures contracts, there is no such agency for climate contracts as they exist today. And Krista, if I've misstated anything, step in there.
I think you answered it perfectly.
All right, good. What is the source of the estimate of annual potential of 100 million metric tons of CO2? So
that's a UC Berkeley paper. I can attach that, or if it doesn't get attached, please send me an email. I'm happy to share that with you and share that information.
And I believe this next question, how much is the 100 million metric ton of CO2 of total U.S. emissions? I believe it was 10%. Am I getting the magnitude of that right, Sarah? I
think they're asking us to divide this sequestration potential by the number of emissions.
Oh.
So we don't have that, but we can calculate that. That's a good question.
All right. Was the poll question in reference to the value to the farmer or the value exchanged on the market? So that's a good question. We weren't that precise. I was thinking of it as the value to the farmer, actually. But that is a good comment concerning the layout of the question. The elephant in the room regarding climate change is no one seems to want to ask who wants to give up their lifestyle first, and obviously there is something to that. If you want to reduce your carbon footprint, turn off your air conditioning and don't fly in a plane. Do you see any opportunities for investors who own farmland to act as a more efficient aggregator for farmers rather than the large agricultural companies? What incentives could there be for landowners to nudge their farmers to do these programs? That's a good question, and frankly, I don't have an answer to whether an investor could compete better than the current host of characters on there. I suspect that there will be more innovations along the way, and if landowners would want carbon policies or carbon conservation, etc., adopted on their own land, it's they can talk to their farmers and negotiate those sorts of things as they see fit. With limited land resources, what crops or practices do you see shifting in favor of earning carbon points? And right now, if you're looking at Illinois, Midwest in general, in crop production, with all those caveats, you reduce tillage, you will increase modeled carbon sequestration. If you plant a cover crop, you will increase carbon sequestration. Again, I would stress that those are model results, and I have no reason to doubt the models, but again, they're model results. They're good studies, but when we move out into practice, things happen. So cover crops, reducing tillage, actually corn sequesters more than soybeans. You could think about moving to alfalfa, but then you have to worry about other things as well. So CFTC, you're right. We have a comment here. CFD does not regulate the CME climate contracts. Yes, they would. They would. CFTC would regulate the CME climate contracts. What I meant to say there wasn't anything equivalent to that for anything that's non-traded on publicly traded markets. Is there any way the incentives could be taken advantage of? For example, purposely over-tilling so that you can get more carbon credits in the future. This is a question that's come up a number of times. Right now, carbon credits are being paid for additional practices. That does not reward the individuals that have been doing these practices for a long time. And one can just say right now that the people that are the companies that are buying these carbon credits want to see more of those practices, so they want to reward more of the switches to those practices. So we are at the end of our time. Appreciate you all attending this. Todd, you want to wrap it up?
I do. Thank you very much. Gary Schnitke, of course, an ag economist on the Urbana-Champaign campus of the University of Illinois, also joined by Sarah Sellers and Krista Swanson for this FarmDoc Daily Update webinar. You're already signed up if you're here for the next in this set. This one, of course, was on carbon markets next week. We'll talk about grain price outlook. That'll be after USDA's WASDE, which is out tomorrow. Our thanks also go to Jim Baltz, who's behind the scenes running things today. He's there always. If you have questions, you can always put those in the question box, and Jim will probably see them as well. If you're having some troubles, you can contact me, Todd Gleason. I've been your MC for the day. You have a fantastic day and a great week. We'll talk with you again on Thursday at 11 next week.